This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to your TF Metas Report weekly podcast highlights for the week of Monday, May the 17th, 2021. If you've been listening to these podcasts every week, then you know how important the daily chart of gold is and how important it is to accurately draw the trend line, specifically the bull flag line on the chart. We've always drawn it correctly, which allowed us to catch the breakout about $100 ahead of everybody else. And on Monday, May the 17th, price surged above its 200-day moving average, which is something it held all week long. And that's a very good sign of more gains to come. Now, next week might be kind of tough because of all the option expirations and the June contract going off the board. But we still look very solid heading into June and getting back toward $2,000 an ounce by early July. The chart shows us that. That's one of the things we talked about back on Monday. All right, here's gold in the daily chart. I wanted to give you all those arrows that we followed for whatever it was, 8 or 9 months during the downtrend, the bull flag. How I told you I always knew I drew this correctly. I guess I didn't draw it as well as I could have today, but you get the idea. We drew it correctly all along. People try to draw it from the peak in August to the peak in January. Even if you did that, we broke out today. So now there's all these people saying, oh, look, gold broke out. No, actually, gold broke out of its bull flag in the middle of April. And if you'd recognize it like we did, you'd have a $100 profit right now. See, there's value to what we do here. Oh, that's $15 a month. I get people that cancel, no longer can afford. Oh, man, I'm trying to help here. You draw the line correctly, that's a $100 rally that everybody else missed because they didn't realize that was the correct line, that purple one. And we knew that was the correct line because we started following the lower red one in the middle of August. And once we figured out that was parallel to where you draw the purple one through that peak on November the 6th, well then, it all just made sense. And then we really knew we were cooking a week ago when we got above that higher red arrow. Above the 200-day moving average, as you can see, at 1863 today. It'll be 1862 maybe tomorrow. But I think the next key level, you can see why I marked 1880, right? That whole period in the last 3 weeks of January. Yeah. Get above 1880, and we're going to be talking 1920 and then 1960, 1980. So you can see how all these are going to fall in the weeks to come. But it looks pretty good now. On Tuesday, our focus shift to the dollar index, which plunged below 90. If you listen to these podcasts every week, you know that we were watching 91 on a weekly closing basis. 3 weeks out of 4 now we've closed below there, which meant the door was open for a drop all the way to 89. Getting below 90 was a big development, and that was a level the dollar would try to fight to get back above all week long. Got to start with the PIG, the dollar index, because this is gnarly. Look at all these big red candles, especially just in the last 5 or 6, 8 days. Big red candles wiping out. We looked last night and thought, well, look at all the support at 90 since we got back over 90 in the first week of the year. Had some tails hanging down, but never closing below. And I thought maybe we get a tail today. No, we got a wipeout. Said all the way down here, 89.70, something like that, I think was the low. Of the last, 89.77, so it's come up a little bit. I would suspect, again, with this having been an important support level, that it'll get tested to see if it's now become resistance. If it does get tested, then there's going to be some pressure on gold and silver tomorrow. But if it fails, it's kind of like we failed to get back over 91 last week. Man, and we take out these lows from earlier today, we're going to go down here and we're going to plumb these levels from the very first couple of trading days of this year. Already, this is the lowest close since, January the 5th? So if we start falling further from here and we start taking out these levels from the first week of January down here near 89.40, that's going to be big news. You can see the headlines now. U.S. dollar index closes at lowest levels of 2021 as Fed does this, that, or something else. So you can see that coming, okay? But don't be surprised if in the short term, meaning the next 24 hours, you get a little bounce back up there toward that 90 level. On Wednesday, my scratchy voice got even worse. But that didn't stop us from talking about the big news item of the day, which was the Fed minutes, the FOMC minutes from the meeting last month, and how suddenly, out of the blue, there was discussion of taper, even though Chief Goon Powell said they weren't even thinking about talking about tapering. Now, why would that be? Well, we don't just discuss the precious metals at TF Metals Report. We are all over macroeconomics, Fed policy, you name it. If you're going to follow gold, you got to follow everything. So back on Wednesday, we talked about a looming problem within the reverse repo market and what that might mean. Here's just a small sample of that discussion. Let me see if I can sum this up. So in their QE program, so that they can claim they're not directly monetizing all of the debt, the Fed buys treasuries. They bring them with new created cash. Then they take the existing cash from the banks or primary dealer banks, and they force this repo onto them, where they force the treasuries onto the bank balance sheet in exchange for cash, and they say, oh, look, see, it's a one-to-one zero-sum deal. But the banks can only do that as long as they have the cash. And the fact that now they're doing a reverse repo at unprecedented levels since 2017 means the banks are out of cash, which means the Fed can no longer keep up this level of QE, which is why after just 3 weeks ago, Powell says we're not even thinking about. All of a sudden they are? What does this mean? I don't know. Does that mean that we're going to get some taper talk in June? Does that mean the dollar's going to spike? Does that mean that rates are going to spike? Does that mean the metals are going to go to crap? Maybe. I don't know. Doesn't necessarily have to mean that. The realization that we're going to direct debt monetization because the Fed can't stop, because where else is the money going to come from to fund the U.S. government? Maybe that's good. Man, it's crazy. But that's what I think this all means, okay? On Thursday, we welcome back our old friend Alistair McLeod of Gold Money. Alistair of late has been all over the story about Basel III, the regulations written back in 2014 that are finally going to start to go into effect at the end of next month. This will have a dramatic impact on the current global precious metals markets, particularly all the shenanigans in London. If you get a chance, the entire interview is posted for free for anyone to listen at TF Metals Report. I would strongly encourage you to listen over the weekend. Here's just a small sample of what Alistair had to share with us.
A counterparty risk in the system, which could actually act as a domino effect.
There you go. So they looked at
that was the thing, and this was the whole basis behind this net stable funding ratio.
They didn't just decide to do this out of the blue. This was a reaction to the previous crisis where these bankers, the hub of bankers in Basel, said, wait a second. Now, one of the things we're going to have to address is all this gold nonsense that they've been doing since 1975.
Well, it's not just gold. I mean, that's
true.
This is far wider. And in fact, the original document on this net stable funding thing came out in the beginning of 2014, and it was finalized in October 2014. So this is not a new story.
Okay.
It is something which, it's so far in the future we can't worry about it. I mean, we don't really understand it. So, we'll look at it later. I think it's been very much in that sort of category. But I do know that there have been quite a number of conversations with the Bank of International Settlements, or more specifically, the Financial, Stability Board, which is the if you like, the committee which is ultimately responsible for this. Someone I know who attended one of those meetings told me that, they just laughed in their faces. I sort of think, okay, well, this is just staggering. Now, I mean, what is the motivation behind this? We can dream up all sorts of lovely conspiracy theories that actually what they want to do is destroy the derivatives market. You could say that they understand that unallocated gold is a derivative market, and with a massive level of turnover, I mean, daily settlement is in the order of 30 million ounces, but the turnover under that is considerably greater. And not only that, but if you actually look at the true numbers, that 30 million ounces daily settlement average is actually between members of the LBMA.
Yeah.
It doesn't include dealings between members of the LBMA and non-members, in other words, members of the public, and it doesn't include central bank dealings. So you can see that all you're looking at that 30 million is the tip of a very large iceberg.
Yeah.
I mean, this is massive. So if you're a regulator sitting in Basel and you're tasked not to have another great financial crisis, you look at this and you think, well, this actually, we don't know how it could destabilize the whole world. Well, it could do, but there is a big risk that it will. So therefore, we got to stop it.
Right. And on Friday, May 21st, we got another lesson as to why we call it manipulation analysis here at TF Metals Report. The reason I have a site is I've always looked at the charts with the way that the banks look at the charts. I've been telling you for weeks, if not months, that the price of COMEX silver has yet to finish above 28 on a weekly closing basis. And that when it does, that would be the key to unlocking 30 and 34. So what do we get today? Another massive slam, as you can see on the chart here. For a few minutes, we were allowed to trade above 28, just as we were on Thursday and on Wednesday and even back on Monday. But as we approached that weekly close, price was slammed below $28. And so we're just going to have to wait another week to see if we can get above there. And we will. We're just not going to do it today. Thank you for listening to the TF Metals Report weekly podcast highlights. We'll have another one of these reports for you next week.